Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Goldman Sachs reports that US money markets are heading towards another month end spike in overnight lending rates this week. This sharp but brief increase happens as Wall Street banks absorb a huge influx of new treasuries, temporarily driving up the cost of overnight borrowing. All of this is unfolding just a week before the Federal Reserve meeting to discuss the pace of rate cuts, amid data suggesting the US economy remains resilient. Investors are also on the edge as they await earnings results from major companies, including big tech firms that account for nearly 42% of the S&P 500's market capitalization. Good morning, JK. What are your thoughts on the markets and the key stories you're following?
Hey, good morning, Swaraj. I think we are on the cusp of a very volatile period as we head into the slew of data that starts today. And of course, taking different markets perspective, I feel the bond market remains in focus still because the yields are still rising. Yesterday, we saw very poor response to the fresh issuances of 2-year and 5-year notes by the Treasury, and that led the 2-year and 10-year yield to hit a new cycle high. And of course, that big Trump trade is still ongoing, where market is selling bonds and keeping themselves in position to face higher fiscal deficit, as Trump victory would mean lower taxes. And the upcoming data also does not give much of a comfort for the bond traders, because after sleepy Tuesday starts a plenty of data, and we have the key JOLTS job data opening in US. And this data, of course, shows job openings have been falling for a few months. So are the quits. And these are two definite signs of an easing job market. And on the other hand, non-farm payroll at the end of the week has been volatile. Unemployment rate has inched up above 4%. All of these indicators, show that the economy may be, just starting to slow down, because job market is seen as a leading indicator. But with all other indicators remaining steady, and market more looking at the higher deficit and the higher borrowing that the US government is likely to do, the yields are unlikely to come down, and that keeps support for the dollar. Also, let us also remember that the PCE inflation that will be due on day after tomorrow is also seen inching up on a month-on-month basis, though on a year-on-year basis they are slightly down. Personal income and personal spending, they are also seen jumping by 0.2% on a month-on-month basis. So the economy is still, steaming ahead overall. At the same time, we are not getting any strong cues from the other economies on a relative basis. So US dollar remains strong for several reasons. And of course, a possible Trump victory can be one of them, with polls still pointing to a good lead for him. Stock markets are the ones which have been unperturbed by either Trump victory or Harris victory, or even yields going up. They have been chugging along because I think the earnings reports have not been bad. And as you sell more of bonds, you are probably diverting more money into the stocks. The other asset class which has been steady is gold and silver, which is slightly surprising because higher yields would have expected the precious metals to drop, but that is not the case, because I think investors are, keeping one safe asset in gold, in case something unusual or a risky event were to turn out after the next 10 days. So dollar index slightly weaker overnight, but that does not mean much, because overall It is headed higher. Dollar index, sorry, dollar yen is steady above 153, and also the euro, which has its own problems, will about growth and also lower inflation, is definitely having a way down much more, perhaps towards 1.06 in the coming weeks, if not earlier. We are faced with a strong dollar, and that is actually not helping the rupee also to recover, because rupee has traded in one of its narrowest ranges, daily range of 0.75 paise yesterday. That speaks volumes about the tight leash it has been held in by the central bank. The dollar index hitting 2-month high of 104.50, nor the continued outflows have been enough to move the spot out of its range. But what we are seeing is the willingness of the central bank to spend out of its hefty reserves to ensure that the rupee does not fall beyond 84.10, at least so far. I believe if only we get DXY above 106, the previous high, or the resumption of large inflows, can see the rupee move in either of the direction. Till then, we should contend with very tight ranges. Just to end this with a very interesting outcome of a survey conducted by ING with their clients in China, and the Chinese clients overwhelmingly support uh, Trump victory, and they prefer Trump against Harris, because the reason given being that he was seen as simpler in prioritizing economic and trade related objectives, and maybe less restrictive in other areas against China. So, something to chew upon even as we head into the elections. Thank you.
Thanks, JK. And just quickly summarizing, the bond markets, 2 and 10-year yields hit new cycle highs as issuances did not generate a very positive demand. And of course, the data stream starts today. George data will be out. Previously, it has shown falling job openings and higher quits rates. On a relative basis, still no positive data from other economies, which has helped keep dollar stronger. Stock markets in the US are showing remarkable stability despite the very heavy data and events ahead. And a strong dollar, of course, isn't helping the rupee recover as well. It remains in a very tight range on the weaker end of its broad range. That's it from us, Shwet. Thanks for listening. Tune in tomorrow for the latest in the financial markets.